I figured it'd be nice to start this video right by the water, just like the last one, since it's such a beautiful day out here. And there were some boats. I took some videos for you guys to throw in here so you can feast your eyes on some of the beautiful weather and water conditions we have around here today. And let's take a walk through the neighborhood and talk about how these economists are completely freaking out over this most recent Fed interest rate hike, which I find fascinating because people kind of act like they didn't know it was coming or something like that. Like it's a big surprise that the Fed decided to hike the rates, you know? Like they've been saying all year that that's what they're going to do, but people just refuse to listen, I guess, because it's now thought by a lot of economists that the Fed has a new target in mind when it comes to the federal funds rate, and they think that it's going to be around 6%. And before, the target was hovering between the 5.25 and 5.5%, and now that they think it's going to go even higher than previously anticipated, these economists don't know what to do with themselves. Because on the one hand, you have economists who are grounded in reality, similar to me and other good YouTube channels out there that say that the Fed is not going to be able to get inflation under control until they raise interest rates above the rate of inflation, which is common sense, okay? But of course, the economists that are against this and think it's a big mistake that they continue hiking at the moment are saying, well, I guess it doesn't matter that we're having this banking crisis. Of course, the latest bank to potentially go under is Deutsche Bank, another one. That's another huge player in the banking business. And the funny thing about this is so much of this is synonymous with back before the 2008 financial crisis. I've seen some people talking about this on YouTube as well, where you can literally go and pull articles from back around the 2007 time frame when the market was basically already starting to implode, but a lot of people couldn't see it, similarly to now. And all you have to do with these articles is replace the date, because it's almost the same thing over and over again. And it's fascinating how quickly people forget history. I mean, forget about the Great Depression. That was, lifetimes ago for most people, but we're talking 15 years ago, and already people forgot. Right now, small banks have reported $270 billion in commercial real estate loans that are likely going to be pressured as the economy weakens, which complicates the outlook for credit availability in the months ahead. And I already made a video about this earlier in the week, guys, about the credit crunch being the next boot to drop. And all I'm hearing about now, just like with the banks collapsing, is the tightened availability of credit that's already happening in the commercial sector and is likely to bleed over into the residential real estate market and consumer lending market as well. The Fed even came out and said that this is likely to lead to tighter credit conditions, but people just don't want to hear it. They just think that it's all going to turn around and that the Fed's going to change their mind tomorrow and it's all going to be a pivot and we're just going to go back to how hunky-dory it was when we all had the free money coming in. We have so many things that are adding up to this recession right now. You have the housing market basically non-existent when it comes to closed home sales. You have manufacturing contracting. You have the inverted yield curves for the longest time now. That's just screaming recession. But you have people that think that this can still somehow be reversed or averted. People are still drinking the soft landing Kool-Aid and thinking that it's all going to get better very soon, guys. Just like that mortgage thing we talked about yesterday. These guys sending out emails saying, oh, the Fed's going to cut rates in the summer, and this is going to be good news for the housing market. Like, yeah, right. I mean, yeah, it's great news if you can get a lower interest rate. Not so great news if you can't pay your mortgage if you don't have a job. But these economists that are against these rate hikes are saying, hey guys, inflation's coming down fast, okay? You got gold prices going up, interest rates going up. They're freaking out because rental prices for residential rentals have gone down 18% year over year. Like, hey, finally guys, right? I'm sure you renters out there are going to be relieved when you go to renew your lease or find a new place to live. And let me tell you right now, guys, if your landlord tries to raise your rent this year, even higher, and you already had a rate hike last year, find somewhere else, because rent prices are going down basically everywhere at the moment.
Well, what do we know? Big surprise, another flip. This house sold back at the peak of the last housing market, guys, for about $1.595 million. And then this recent buyer bought this place for $4.43 million in 2021. Now they're asking a whopping $6.4 million. And I guess they maybe are a little surprised that no one is coming along and buying it. I wonder if a property like this will ever actually sell.
They're also saying how big of a contributor that the stated rents are to the latest CPI numbers. They're saying how natural gas and oil prices have been going down, which is helping consumers pay less for energy. Like, tell me who's paying less for anything right now, guys. I just don't see it. I still see gas prices at the pump close to $3.50 a gallon here in Florida. I don't even want to know what the price you guys are paying over in California. Probably likely close to $6 a gallon if I had to guess. You already have people in California complaining that their natural gas bills are going through the roof because they're charging more. But yet you have these economists saying that all this stuff is going down in price and this is really going to help lower inflation along with the rent prices going down. Like, give me a break, guys. It's not going to happen. A lot more needs to change before inflation is just going to magically disappear. It takes a long time for inflation to go away like this.
And you can see just a couple doors down, we have a house very similar to this last one in terms of size and square footage, and they're asking a whole $1 million less, and it hasn't sold yet. But in all fairness, this one has only been on the market for about a month and a half, and they've already cut the price by about 400 grand. So this seller is probably a lot more motivated than the previous one. But make no mistake, this is also a flip. They only paid $2.7 million for this place just a year ago, and now they're trying to sell it for double. So it is also Looney Tunes here as well.
And then on top of all this, they're saying, hey, wait a minute, guys, this is not the 1970s. The Fed should get ready for a pivot real soon before they break more than just the banking system. And they're basically saying that they've already tightened too much, too fast, and it's time for a reversal. And the reason why they're saying this is because people like this are really starting to feel the financial pinch from these interest rate hikes, and that's exactly what it's designed to do. Honestly, guys, things need to get real messed up and real broken for anything to resemble any sort of normalcy at the moment, okay? If they just let things go like they are right now, inflation's never gonna get under control, and it's gonna get to a point where everything's so expensive, then the economy will implode on itself just because of that. So inflation has to be the #1 goal here, regardless of what happens with the banks or more businesses failing or whatever. That's what needs to happen right now, but people like this just don't want to see that. Now check this out. Anybody who bought a house in San Diego a year ago or so, well, guess what? You're probably underwater on your mortgage now because home prices in San Diego have been plummeting. Just from 1 year ago, you had home prices in San Diego now drop 2.6% in just the last year, which honestly is nothing compared to what has happened in places like San Francisco and Austin, Texas, and in Phoenix. These places are seeing double-digit decreases in home values in these areas. So San Diego's lucky so far. But a lot of people think that this can't happen where they live and that, all of this is just going to be temporary and it's all going to recover very soon. Housing market's going to the moon because the Fed just did $300 billion worth of QE going into the banking system. But funny enough, the actual housing market's not reflecting that. Now it is too soon to tell because this whole round of QE that they did with the banking system literally just happened about a week ago. So we haven't really seen the effects of that yet. But like I explained in an earlier video, I think that this isn't going to have an impact on the housing market from the perspective of this money is not landing in your hands or my hands in order to buy a house, guys. This is just to save banks from failing. That's all this is. It's just to kind of stop the bleeding. It's a Band-Aid solution to a much bigger problem. So this is not money that's going to get lent out in the form of low interest rate loans for people to go out and buy like there's no tomorrow. But the good news for you folks in San Diego that did buy a year ago and are now underwater on your home's value is that you have a lower mortgage payment than what somebody would be getting today. And that's really where the value is for people like that. And you have to do everything you can to try to hang on to that mortgage. Because check this out, if you paid the average price over there of $750,000, your mortgage payment today would be around $4,075 a month, versus if you bought a year ago, it was $3,109. So you're talking $1,000 more a month if you just bought a year ago, guys. So that is the one advantage that bought during the height of the pandemic have. But unfortunately, the values of these homes are dropping below what they paid. So if people in this position have a need to sell for whatever reason, who knows what, you can think of a million reasons why someone would sell, then they're in trouble, okay? They're gonna have to sell at a loss or flat out short sell the property. That's the reality. And once again, another story talking about how mortgage rates are likely to stay high despite the falling treasury yields, because typically mortgage rates move in tandem with the 10-year treasury. And so far they have been, in the sense that we've seen 30-year mortgage rates go down as the treasury yields have gone down. But because we're entering a time when credit is about to get a whole lot tighter, the treasury yields may move lower. That might not be enough to actually take mortgage rates with it. And this is the easiest way to think about this, guys. Basically what this credit crunch means for the everyday average person is you're not going to be buying a house with a 600 credit score or a low down payment or whatever. Only the most well-qualified borrowers that have money in the bank, that have assets, that have high credit scores are likely to get approved for new mortgages in this tighter credit crunch environment. And what that translates to is even lower home sales than we're already seeing right now. And if more homes continue to hit the market, well, there goes the inventory increase that we've all been waiting for. And the idea here is the amount of people buying homes goes down enough, then that's going to slow the economy even further and will help inflation go down, which is true. But then the thing is, guys, what you have to keep an eye on is once we see mortgage rates coming down, we know that the switch has already been flipped. That's not a buy signal. That's not a signal to go out and buy a home. It means that the recession is officially here, and now you need to make sure you can hang on to every dollar you can, because you don't know where the next one's going to come from. And I believe that when interest rates start coming down, it's also going to incentivize a lot of people who are would-be sellers but are not selling right now because the rates are so high to actually list their homes for sale. Because a lot of these people have very low rates and they want to get out of the house for one reason or another, but they don't want to pay a 7% interest rate on their new home. Makes sense. But if rates start dropping down to a reasonable level, it might be enough to make these people, go ahead and list the home for sale and try to get something else. But that's the other thing people need to keep in mind, is the more inflation starts coming down, then the higher likelihood of further job losses and more layoffs. In fact, the Fed said this week that they expect unemployment rates to go up to 4.6% by the end of this year, which translates to roughly another 1.5 million people losing their job between now and New Year's Eve, okay? So that's a lot of people without work, guys.
I don't know who pays this much for rent, guys, but this house is for rent for $17,500. It's been listed for 3 months, and they originally tried getting $21,000 a month for rent. And I just don't know who in their right mind would actually rent something this expensive, because obviously if you have that kind of budget, you could buy almost any house we walk by here in Miami, without even blinking an eye. So why would you pay this much in rent? I just don't get it.
And I just can't help but think that all of this is just the perfect storm right now. You have inflation still too high. You have layoffs ramping up. You have the credit crunch that is yet to even be felt by most people. And another thing that could spur more people to actually sell their homes when otherwise they might not is increasing property taxes, guys. We talked about this in a video about a week ago about how this is one of the most unexpected higher expenses from new homeowners was the increase in property taxes, that they just didn't think they were going to go up. So I don't know what they were thinking, but they weren't thinking clearly. But it's not just new homeowners that are struggling with this, because homeowners in Jackson, Missouri, okay, just got a notice that their property taxes are going to be going up about 30% this year due to higher home values. So everybody likes to think that, you know, having higher home equity is always a good thing. Well, in reality, it can backfire, especially if you cannot afford to pay these higher property taxes. I mean, 30% increase in 1 year is very high. I can't help but wonder how many people is this going to spur to list their home, because the expenses are just adding up. They're having higher property tax expenses. They have higher homeowners insurance premiums. They have higher cost of repair now than before due to supply chain issues and higher labor costs. Like, you name it, it costs more now. The cost to heat or cool the home, you know, like whatever, guys, the pool maintenance, it all adds up now. And how many people are going to be able to absorb this extra? I don't know. I guess we'll find out real soon. It's going to be an interesting spring housing market, to say the least. Now, the latest financial concern when it comes to the markets is the sheer amount of money that has been entering the money market accounts, especially just in the last week, guys. $120 billion went into money market accounts in just 1 week, which obviously had a lot to do with these bank collapses. And over the past year, the amount went up 400 billion total. So you're talking, you know, a quarter of that in just 1 week. And the total amount invested in these money market accounts right now is $5 trillion, which begs the question of, is this the next bubble that could potentially pop? They're saying that a bunch of the money that has come in recently came from institutional investors, which was about $101 billion from institutional investors, and then about another $20 billion from retail investors, people like you and me. And remember that guy that I was telling you about, that I heard his conversation on the boardwalk about how he lost already $9 million in the stock market? Well, that's where they think you're going to see an even larger surge of people selling off stocks and putting money into these money market funds. And it's anticipated that there could be as much as a $1.1 trillion sell-off in the stock market coming soon, and this money flowing into these money market accounts. And then the problem that this causes essentially is you have all this money surging into these money market accounts, and because everybody's looking for the safe haven investment, right? Well, at the same time, people could also be pulling money out of these money market funds all at once as well, just as fast as it went in, which can create a liquidity crisis in the money market and basically have the same problems as the banks, where when people want their money, they're not going to be able to get it. So how about that? Turns out money market funds are deeply interconnected with the wider financial system and pretty much face the same exact risk that banks do. What do you know? They typically invest in securities that mature in about 90 days or less, which means that they're very sensitive to changing interest rates. They also invest heavily into commercial debt, and we know there's a big problem with that. And if there's a significant economic downturn, the issuers could default on their obligations. So what happens then, guys? You put all the money in the money market account, that starts to fail just like the banks. And I didn't even know this, but it turns out as recently as 2020, the Federal Reserve and the US Treasury had to step in and save the money market accounts for the same reason that they're looking at these potential threats right now. You know, you had a lot of people trying to pull all the money out at once, and basically they had to step in and backstop that, just like they're doing right now with the banks, which I didn't even know that. And back then, new regulations were suggested by the Treasury, but nothing was actually done about it, and this whole system is still just as vulnerable as it was back in 2020. This is why I do think that they should look at something like expanding this FDIC insurance to unlimited amounts, and people that have over the $250,000 coverage limit need to pay an insurance premium if they want to make sure their money is going to be safe in the banks or these money market accounts or wherever they want to stick it. I mean, I don't know what else to do, guys. I mean, I think that's the best idea I've heard so far. You know, it's not the perfect idea, people don't want to pay to have money in the bank. Certainly you want to be paid interest to have your money in there, not be paying them, right? But that's the price to pay for being rich, I guess, and wanting to keep all your money in the bank and not invest it into something else. So get ready for the credit crunch. Make sure you guys don't have any debt, especially with these interest rates going up, and just have things saved, guys. Have money to pay bills for months on end. You know, have food to eat. I think just having extra of anything that makes your life comfortable is a pretty good idea right about now. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.